So spot trading is generally short-term trading, so if you're just trading for a day or two, but if you want to hold it for longer, the broker will automatically roll it for you into the next day, and you may pay a fee for that. Forward trading is when you trade on a date, or you choose a date ahead of time for the contract. So if you want to hold a position for a week, you can choose that date as your forward date, and it means that the contract will expire on that day. The advantage of booking a forward contract over a spot is that you're not paying these rolling fees every night. It's all factored into the price that you paid when you opened the trade. And lastly, there is an option contract. Now, an option is slightly different to spot and forward trading, because rather than actually entering into the market at the rate that you're given, instead you can use that contract to reserve a rate. So if I wanted to buy oil, for example, and it's currently trading around $60 a barrel, and I expected the price of oil to go up, I have a few different choices in what instrument I could use. I could do a short-term position, and in fact in oil you use a futures contract, which is just another word for a forward. Forward for the currency markets, futures for commodities. So I'd use a futures contract and I could buy oil at $60 a barrel, and if it goes up I make money. And my risk exposure in that situation all depends on where I put my stop loss. I could put my stop loss at 55, which means I've got a $5 risk, and I could put my take profit at 65, which means I'm going to take profit at $5. So an option is slightly different, because rather than actually getting into the trade there and then at $60 a barrel, instead you can reserve a price in the market. So I could reserve that $60 as a buy price with my option, and I would pay a fee to do that, just a fixed fee. And then if the market were to rise, so let's say it did get to 65, my option has gone up in value, the contract has gone up in value, because via the option I can buy at 60 at a cheaper price than what the market is actually offering, 65. So because my option contract has gone up in value, I can then sell it to someone else or close my option contract and take that profit. And on the other hand, if the market falls, my exposure is just what I originally paid for that contract. So when would I want to use the futures contract, and when would I want to possibly use the options? It all depends on what you expect to happen with the volatility and how much risk you want to take. In the futures, you know that if there's a lot of volatility, your stop loss may get hit. But if you were unsure about that, you could see your risk up front with the option, and if the option is at a value that you believe to be good, so if the cost you have to pay for that option you believe is a low risk, a comfortable risk situation, then you can take that option and avoid the risk of having your stop loss hit out. So there's choices to be made in the market between what instruments you trade.
What's the difference in the leverage of a spot or forward trade compared with the leverage of an option trade when buying?
So the leverage of a spot or forward is fixed, normally fixed by the broker. 1 to 200, 1 to 400, whatever you're getting from the broker. That will never change. But when you're trading an option, there's an extra variable that you have to consider. So like any trading, you have to decide what pair do you want to trade. Do you expect that pair to go up or down? Over what duration do you want to trade it? And what deal size do you want to trade? These are 4 parameters that you have to consider with any trade. But with an option, there's an extra parameter, and that's the rate that you're reserving. And we call that the strike rate. And you get to choose. You don't have to reserve the rate that's currently available in the market. Going back to the oil example, oil is trading at $60 now. I can reserve that $60 over the next week if I want to with an option. Or I could choose to reserve a worse rate. So if I expected oil to move up a lot, and I wanted to target, let's say I expected oil to move above $65, I can reserve the $65. So I'm reserving a worse rate than the market is offering at the moment. Now, why would I want to do that? Because if you do that, your option costs less. The amount of money you pay to buy the option is a lot less. So what you can create is a very high leverage trade, because you're putting less money down, less risk, but the risk is still fixed with no stop loss. So normally where high leverage is talked about being very dangerous because of the high risk involved, you don't know how much you're risking, a small move against you is going to knock you out. Actually, when you create a very high leverage trade with an option, your risk is small and your risk is fixed with no stop loss. So it creates a new opportunity there. But of course, and I should say this, if you are going to use an option to reserve a rate that is worse than the current rate, then the probability of that happening is lower as well, because the market needs to move further before your option contract will pay out. But it can create some nice opportunities, and you can decide whether you want to take on the larger risk or the smaller risk, depending on your outlook.
You have access to them all. Do certain sort of instruments tend to gravitate towards certain psychologically, that sort of psychological fit trader?
Yeah.
But, I mean, if I'm wrong, you don't have to answer.
Yeah, no, I think that's the great opportunities that options offer, is that you can avoid the psychology of being hit out by a stop loss, of moving your stop loss further away, because you know what you're paying up front and you don't have to worry about getting hit out. So I believe that options can be used to decrease the risk compared to spot trading. But of course, you've got to know at what times in the market to use it, because an option price factors in direction and also volatility. So if there's going to be a lot of volatility in the market, buying options could potentially be a very good idea because it protects you from that. But at times when there is less volatility, it may be better to use a different instrument. So you have to know when to use it. But if you have the choice, then of course you can reduce or diversify your risk in that sense. Coming back to the psychology of traders, and that some traders run their risk too much and they come out of their profit too quickly, buying options as a way of trading would suit these traders because they don't have to be considered with the stop loss and being wrapped up in the trade. So it provides that security. You can sleep at night, leave a trade on overnight without having to worry about being stopped out or risking more than you put into the trade. No, what you put into the trade is your maximum risk. So yeah, I believe it's a very good solution for those clients that are looking for that extra security in the market.